So are bonds a good investment for individual investors to consider today? Well, that's a question, again, I get quite often. And the way I answer that very simply is it depends on all of you watching. Do bonds make sense? Are you okay with a 4 to 5% rate of return? On some short-term bonds, as I'll show you just shortly, in the US, for example, you're making even more than 5% on a short-term bond instrument or money market instrument, treasury instrument. So are bonds right for you? Well, again, it depends. Are you looking for medium risk, conservative growth, 7 to 10%? Then bonds may not make sense. If you're looking for the portfolio to increase by 7, 8, 9, 10% a year, then maybe you could buy bonds for a portion of your portfolio. If you have bonds paying you 5% or GICs paying you 5%, and stocks, equities, mutual funds in general, equities paying you 10, 12%, well, 50-50 split, you're probably making somewhere in the vicinity of, let's say, 7 to 8%. Is that a good rate of return? Especially considering 50% of your money would be in a low risk type of investment, or 50% of your portfolio is in low risk and 50% of your portfolio is in medium risk. So stock market reaction and volatility will only affect half of your portfolio. So some people actually like that. They like the idea of having a mix of bonds and stocks, or bonds and mutual funds, or GICs and stocks, etc. So is the bond market right for you? Again, it's all going to come down to what you're looking for, what you want your money to do for you, what your investments should do for you. And I have a chart here. We can show United States rates on bonds. Actually, I have two charts, but the first one here, you can clearly see the rates on yields. The 3-month rate is actually 5.3%. You can look at the 6-month rate here, 5.5%. So these are 3-month, 6-month rates. And you can see that they're greater than the 10-year rate, which is only 3.99 or 4%. So you can see how things are a little bit wonky right now. Short-term maturities are paying more than longer-term maturities. And I have a second chart here, which will show exactly that. We always like to look at what we call the 10 and 2-year treasury spread. And that's the difference between what the 2-year bond rate is and the 10-year bond rate is. And you can see here clearly that it's inverted. It's upside down. And you can see recently it's gotten a little bit better as the 2 years come down and the 10 years gone up a little bit. But when you have a 2-year at 5% and a 10-year at 4%, that's a little bit weird. And if that's what you're thinking, you're 100% correct. And I say it's weird, but that unfortunately usually indicates to us that a recession is coming at some point. Now, I will tell you, as you can see by this chart, we've had an inverted yield curve for quite some time, and we have not seen a recession as yet. When the recession comes, well, we'll get into that in a little bit on the show. But overall, we haven't seen a recession. So hopefully we can see the bond curve, or the yield curve, start to flatten out and then go back to the way it's supposed to be, where the 10-year or the 5-year is paying more than a 2-year or a 1-year investment or a 6-month investment. That would be a more traditional or normal yield curve. What we're seeing now is definitely not normal or traditional as we're used to. So going forward, are bonds right for you? Well, that's a question to ask your investment advisor and ask them, see what they say. They'll provide you with some guidance, but really it'll always come down to the investor. What types of returns you're looking for, and what do you want your money to do for you?